Welcome to video 7C on passive losses. You haven't seen my face in a while, and my ego and my narcissism simply won't allow that. So it's nice to see you guys again. So this video is about passive losses, but really it's about much more than just passive losses. We're really going to dig in on some loss limitations and put yourself in the shoes of the government, right? So taxpayers love losses. Why? Because they reduce the amount of tax they have to pay. So the offset is when you're in the government, you kind of hate losses because what they do is reduce the revenue you get to take in. And so taxpayers come up with schemes by which to deduct losses, and in what can only be described as a cat and mouse game, then Congress needs to come up with ways to slow down, defer, or simply not allow those losses. So this chapter digs in on our very first one of these, and this is a very complex area of tax. And so, we're going to deal with this one, and then we recur on this in a very big way in Module 5 when we do pass-throughs, because largely these passive loss rules apply to pass-through entities, but neither here nor there. And then in Chapter 9, we're going to deal with even more types of loss limitations. So what I would say is let's try to struggle through this superficial coverage that we're going to have in this module. It's not going to feel superficial to you, not going to lie. It's going to feel very complex. For those of you that had me in 503 over the last year, we're digging back in on the Molly questions, right? So this is about basis, at risk, and passive losses. So rather than you have to look at my ugly mug any longer, let's go ahead and get started. So let's say that Rod receives a $50,000 inheritance from his mother. Let's just call his mother Maud. And his friend Milhouse and he decide to form a partnership. And he contributes the $50,000 inheritance, and Milhouse somehow manages to gin up $50,000 as well, and they form a partnership. So they've invested $100,000 total, and that partnership goes out and buys $1 million office building. Now, of course, how does it do that, right? How do you buy something worth $1 million with only $100,000? Of course, you take out a loan. And they hire a management company, and this building starts to generate rental income. But it also has very large depreciation deductions. And so even though it has positive cash flow, it generates tax losses. So let's just use some hypothetical numbers here and say that you can see that the gross rental income is $90,000. And then once you deduct all the fees, there's a very thin profit margin, right, of $5,000 before depreciation. But then there's the depreciation deduction, and then they end up with a tax loss. Now, the interesting thing about this is let's think about depreciation for a second and what kind of deduction that represents, right? So that is a non-cash deduction, right? You are recovering your investment in some sort of long-term asset, property, plant, and equipment, in this case a building, over some useful life. And so what happens is you'd think, well, okay, normally you invest the cash up front, right? And what happens is depreciation is this slow capturing of that cost. But in this case, they've invested only a small portion of the $1 million building that they get to depreciate. So really what they're doing is depreciating what I like to say as the bank's asset, right? But it's in their names and they get the depreciation for it. So they're generating these positive cash flows, but enjoying tax losses. And so the IRS says, whoa, we got to pump the brakes here a second, because this doesn't match up with ability to pay or economics or anything like that. And it appears like this could be abusive. And so if you want to read more about this topic, in Australia, they simply continue to allow this. And it's known as negative gearing. So you can Google negative gearing, and you'll find a whole bunch of articles from Australia about this because they continue to allow it. But here in the U.S., they've tried to find a way to stop this from occurring. And the first one is we're going to limit your loss to basis. And when you think about it, that makes sense, right? We're going to limit the loss to the amount of investment that they've made. So over here on the right is simply a table that kind of shows how you can generate tax savings with still having positive cash flow investment. And of course, it's the leverage that really creates this. And in the US, it's not really quite as easy to borrow heavily against a lot of things, but real estate is one of the things you can borrow heavily against. And so as a result, this is a very common tax planning technique. Okay, so we need to measure Rod and technically Millhouse's investment. So let's just deal with Rod as an individual and say, what has he invested? Well, he did put the $50,000 worth of cash in. Did he put anything else in? Right? And you'd say, well, no, but remember, they took on a liability, right? So when you form a partnership, a general partnership, you are personally liable for the liabilities of that partnership. And so you might say, well, look, they have inherited a mortgage of $900,000 that they are liable for. So if we were to think of Rod's journal entries, this would be one way of thinking of them, is that in some respects, they borrowed the $450,000. Therefore, they have the debt on the books. Right now, legally, it's on the books of the partnership. And then they turn around and invest that cash in the partnership. And there's really no difference economically from this transaction to the partnership borrowing. And that's why in the partnership rules that we cover in Module 5, we'll actually see that when a partnership takes on a liability, that's considered a deemed contribution, right? So we have an actual contribution of $50,000 of cash, and we have a deemed contribution of $450,000 of cash. Okay, so what happens is Rod's basis includes the liability. So the reality is we tried to create a ceiling at which Rod could not deduct these losses, but the basis rules were not very good at doing so. That's not to say there's not no limitation. There is one. But if we go back to the last slide, in our hypotheticals here, the loss is $25,000. How many times can you take $25,000 before you get to $500,000? That's a nice long run for Rod to continue to deduct these losses. Okay, so since basis didn't really work out, Congress says, you know what, we need a better rule, right? We got to find a way to try to capture the economics of this transaction, and basis simply isn't getting it done. All right, so we'll concede that basis is investment plus liability because that's literally the way it works. And when we talked about this way back when, we said, look, if you borrow money to buy something, you get to include that in basis, and this is no different. But what if the taxpayer is not really, and let's put that in air quotes for a second, not really liable for that debt? So there are two types of debts commonly classified as recourse and non-recourse. And if you've never had a finance course, you may never have heard these terms, but a recourse debt simply means that the creditor has recourse against you personally. So what that means is the bank could foreclose on the property and has recourse against you personally to collect that debt. Non-recourse debt, on the other hand, says the bank can foreclose on the property, right? Because that's the collateral. That's the collateral for the loan, and they can always go in and take the collateral. But they do not have personal recourse against you. So once they've foreclosed on the property, they cannot come after you personally. This is what generates the at-risk amount. So the idea is now we're going to measure what is Rod truly at risk for. So if the building burns to the ground and it's not insured against risk of loss, which of course would be crazy, and of course the bank would require that, but hypothetically roll with me, Rod would be out as $50,000. If the loan is non-recourse, which it likely is, that would mean his at-risk amount would only be $50,000, right? He would not get to include the liability. Now his losses stop at $50,000. Now remember, in my hypothetical, he was generating $25,000 worth of losses a year. 2 years and he's done. And now his losses are limited. This is actually starting to make sense, right? We're matching some of the economics with the way the tax loss is getting recognized. However, Congress simply loves real estate. Now, of course, they love real estate because the real estate lobby is extremely powerful in this country. And then the other reason is, a lot of people, legitimate taxpayers, invest in real property. And so the rules are a bit soft, and we'll see this over and over and over again. If you took 503, it explains why mortgage interest and real estate taxes are deductible, even though those are clearly personal expenses. But I digress. So there's this thing called qualified non-recourse financing that Congress invented. And it said, well, yeah, we know it's non-recourse debt, but if it's issued by a financial institution, aka a bank, and it's collateralized by real property, then go ahead and treat it like recourse debt. So think of this. We made the rule, it was going to be effective, and then we walked it right back. So now Rod is back to $500,000 of his at-risk amount. Why? Well, his $50,000 investment and his $450,000 loan would be qualified non-recourse financing. Okay, so when we compare the basis amount, and basis tends to be intuitive for most people, and some of these issues we'll deal with when we ultimately get to Module 5, but at risk seems to be a little more cloudy. But look, when you look at this exhibit, and this is a great exhibit.
Learn it, know it, live it.
Cash invested increases both basis and at risk. Share of debt that you're responsible to repay. Well, what's another way to describe that? How about recourse debt? That's included in basis and at risk. How about the next item, qualified non-recourse financing? That's included in basis and at risk. But the share of debt that you are not responsible to repay, that is not qualified refinancing. That is included in basis, but it is not included in your at-risk amount. Now, we'll worry about those other three a bit later. So as it stands right now, that's really the only difference between these two. So unfortunately, they wrote the rule, and then Congress neutered their own rule by providing this loophole, largely for real property that's collateralized, that is the collateral for mortgages. Okay, so we're not done yet, but I want to move on to a new story for a second. Let's talk about Todd and Nelson.
Hey, Bart, your epidermis is showing!
It is? Oh.
See, epidermis means your hair. So technically, it's true. That's what makes it so funny. Pardon me a moment. Ha ha!
Hey, Nelson, he's really hurt. I think he broke his leg.
I said ha ha!
So Todd and Nelson just opened an organic food market, and they work there day and night. And they're trying to make the business operate profitably. But invariably, like many startup businesses, they suffer losses in the first few years. Now, the system isn't built to penalize Todd and Nelson. The idea would be they should be able to deduct those losses. We can contrast that with Rod and Millhouse, who really were just putting all the bank's money to work. They don't participate in the management of the building at all. There's no sweat equity at play here. So what we want to do is build a set of rules that don't penalize Todd and Nelson, but do penalize Rod and Millhouse.
We found a friend for you to play with.
Nelson, honey, where have you been? Ha ha! Ha ha! Ha ha!
So let's look at this and say, hey, you know what? Let's classify Todd and Nelson as active investors. They go there every day. It's their business. They're working there every day. They're grinding away. Remember, it's all about their sweat equity. Whereas Rod and Millhouse, let's describe them as passive investors, right? And in order to do this classification, the tax law uses a series of rules that differentiate these activities based on the level of participation by the taxpayer. So if you materially participate in that activity, you're an active participant. Otherwise, you are a passive participant. So here are the tests for material participation. And you can see if you read through these, and these are from your text, most of them have to do with the amount of time you spend, right? So how much time are you really spending on this activity, right? Because what we want to do is classify the Todd and Nelsons in one place and the Rod and whoever Rod's partner was, I've already forgotten, in the other place. So these tests allow the tax law to do that. Okay, so a passive activity is any activity which involves the conduct of a trade or business and in which the taxpayer does not materially participate. So for example, a limited partner in a partnership is by default passive, right? Limited partners are not allowed under partnership law to materially participate in the management of the business. And so by default, that's a passive activity. Here's another big rule. Generally, participants in rental activities are deemed to be passive. So this is a little bit like saying, hey, whether or not Todd and his partner were actively mixed up in this business or not almost doesn't matter. Because it was a rental business, it's simply deemed to be passive. Okay. I think maybe we got him now, right? We got Rod and Milhouse. Milhouse is his part. See, it's easy to forget Milhouse because he's such a forgettable character. Anyway, I think we finally got him because passive losses are only deductible to the extent you also generate passive income.
Learn it, know it, live it.
All right. So now when we look at these three categories that we introduced back in the first video for Chapter 7, so 7A, we have portfolio, right? And that was this portfolio forms of income where I invest in financial instruments and they pay me off. These last two relate to business activities where I'm either passive or I'm active. Okay, so Ralph purchases an interest in a limited liability company for $20,000, and his share of debt in the LLC is $30,000. None of this debt is secured by real estate. So like a corporation, the LLC protects Ralph from the LLC's creditors. So what did I just do? Well, I just introduced an interesting novel turn to what we're looking at, which is first I introduced the LLC. Right? This is a limited liability company. That's a flow-through entity. That flow-through entity is treated like a corporation with respect to limited liability, which means that unlike a partnership where the partners are liable for partnership debts, in an LLC, the members, which are the name for owners of an LLC, are not personally responsible for the LLC's debt. Okay, so Ralph's share of the loss for the current year is $60,000. How much of that loss is limited by his tax basis? And then secondly, how much of that loss is limited by his at-risk amount?
All right, first academic alert. Wiggum, Ralph.
I won!
No, Ralph. This means you're failing English.
Me fail English? That's impossible.
Okay, let's take a look. So if we were to calculate Ralph's basis, we would say, well, Ralph gets to include his investment, right? So he purchased it for $20,000. So he's cash in for $20,000. He also gets to include his share of debt. Now remember, basis doesn't care if it's recourse or non-recourse, at least as far as we know in this course. So he gets to include all of that in his basis. So as a result, his basis is $50,000. He can deduct $50,000 under the basis rules of his loss. $10,000 of that loss is suspended, which means that it's not deductible and it can be carried forward until he creates additional basis. His at-risk amount is only $20,000, right? Because he is not responsible for that other $30,000 of debt. So think of that as debt you're not at risk for. It's not qualified non-recourse financing. So as a result, it cannot be included in his at-risk amount. So he can only deduct $20,000 under his at-risk amount. Now, this is a waterfall type technique. So what this means is you have to get past basis before you consider at risk. The at risk can only consider the loss that made it through basis. So how much loss made it through the basis rules? Only $50,000. How much at-risk amount does he have? $20,000. So he can deduct $20,000 under the at-risk limitation. But only $30,000 is suspended, not $40,000, because only $50,000 made it through the tax basis limitation. Okay, so to be clear, there was a $60,000 loss. $10,000 was suspended under the basis rules, leaving only $50,000 available for at-risk. $30,000 was suspended under the at-risk rules, leaving only $20,000 to deduct. But we have not yet considered the main purpose of this video, which is the passive rules. So if he's not a material participant, and we're assuming he's not, and there is no other form of passive income by this taxpayer, then there is no deduction. And the remaining $20,000 of loss is suspended under the passive loss limitation rules. Okay, so let's say that in addition to his interest in the LLC, Ralph owns a separate rental property that actually produced $10,000 of rental income during the year. And he also earned $60,000 of salary from his employer. Okay, so how much of that remaining $20,000 loss, after we apply the basis and at-risk limitations, which don't change as a function of what we have here, how much of that $20,000 loss can he now deduct? Well, he has other forms of passive income of $10,000. So he can now offset that $10,000 with a loss from his LLC. So he actually ends up with zero passive income, right? Because the $10,000 is offset by the $10,000 loss. And now $10,000 is suspended under the passive loss rules. Okay, so the other rule about these passive losses is that if you sell that passive activity, if you close out your entire interest in that passive activity, you are allowed to deduct your suspended passive loss. All right, so we're changing stories again. Mr. and Mrs. Flanders own a home they rent out to students at the local university. And Mrs. F approves new tenants and makes repairs when needed. And their AGI, before considering any income or loss from the rental property, is only $50,000. However, because of bad tenants, their loss from the rental property for this year is $16,000. So if any of you have ever been a landlord, particularly in a state like California, you know that one bad tenant can really sink you because they enjoy a certain amount of tenants' rights, and if they fail to pay the rent, you got to give them 30 days notice, et cetera, et cetera, et cetera. So you can end up in a pretty bad situation. So here we have some modest taxpayers, right? Their AGI is $50,000. But they end up with a really bad year, a really bad loss. Okay, so remember, this is a rental property. And as a rental property, it's passive. And if the Flanders don't have any other forms of passive income, and why would they if they're modest taxpayers, they're not going to be able to deduct that loss under the passive loss limitation rules. Well, that's really not fair. When we think about how that affects your ability to pay, this could sink them. Right? I mean, Mr. and Mrs. F could be in serious financial trouble. So what we need to do is find a set of rules that will allow them to deduct their loss. Okay, so what we've done is Congress has created two exceptions to the passive loss limitation rules. And let's just refer to the first one as Mr. and Mrs. F limitation. Now, that's clearly not the technical name for it. And we'll call the other one the real estate professional exception. So the IRS needs a rule that permits taxpayers that would really suffer from a loss to deduct the loss. Okay, so how do we measure taxpayers that would really suffer a loss? Well, why don't we say, well, that'd be low-income taxpayers, right? So why don't we use a measure of income by which to determine whether or not you get to take this loss? So a more affluent rental property owner, if Bill Gates owns a rental property and he suffers a $16,000 loss, pretty sure he can handle that. Okay, so we need to draw a line in the sand. And the line that's drawn in the sand is at 100,000 of adjusted gross income. And remember, we covered what AGI is. It's an individual measure, but we need it because this is really, like, we're really talking about a business type activity here. So we're going to draw the line at 100,000 in the sand. Okay, so got it. If your AGI's more than 100,000, you can't deduct your passive losses except to the extent of passive income. If, on the other hand, your AGI is less than 100,000, we're going to let you take a passive loss deduction. Hey, that's fantastic. So we've got a nice line in the sand. But the IRS cannot afford all losses. And the reality is, if you're really a moderate income taxpayer, there really should be some limit to the level of losses you could endure, and they would be real. And that's in air quotes. So Congress said, you know what, we're going to put a $25,000 limit. So under the Mr. and Mrs. F rule, if you incurred a $26,000 loss, you can still only take $25,000 of that. Because the notion is, well, wait a second, if you're really that low income, how are you operating in such a risky territory where you end up with such a giant loss? That doesn't make sense. Okay, so wait one more second. You're telling me that if my AGI is $100,001, I get no loss deduction at all? Well, no, that doesn't seem fair, right? Your ability to pay doesn't fall off a cliff. It doesn't just disappear once you make one more dollar of income. So what we're going to do is cover something called a phase out. And the tax law is simply chock full of phase outs. So they're designed to avoid specifically falling off a cliff just because, for example, your income is $1 higher than the threshold. Now, every phase out, and as it says here, there are lots of them in the tax law. Many of them are different, right? So the way they're calculated and constructed can often be different, but they all function largely the same. So let's walk through this phase out so that we understand it. Some of them change from year to year, meaning they're inflation adjusted like our tax rates. Others, like this one, stay the same. Now, I've put detail of this limitation in your table pack, but the idea is if you're going to be a tax person, you just need to memorize the $100,000 limitation and the way the phase out operates. Okay, so this one doesn't change under the Mr. and Mrs. F passive loss exception. All right, so the first rule is you have to be an active participant in a rental activity. Okay, so remember, rental by default says it's passive, even if you're a material participant. If you are actively participating, which is a lower threshold than material participation, that means you do things like approve tenants. You look at the utilities. You maybe, sign the lease contracts. You haven't turned everything over to a management company. So as long as you're an active participant, the phase out starts at 100,000, right? So if your AGI is less than 100,000, you can deduct up to that $25,000 annual limit per year. For every dollar your AGI is over 100,000, that $25,000 limit is reduced by 50% or 50 cents, making this a 50% phase out. So let's start with Mr. and Mrs. F. Recall, their AGI was 50,000. Their rental loss was $16,000. Well, their AGI is below the $100,000 threshold. Their $16,000 loss is below the $25,000 annual limit, and as a result, they can deduct all $16,000. Let's do some iterations, though, because as you can imagine, not every taxpayer makes less than $100,000. So what if Mr. and Mrs. F's AGI was $110,000 with the same $16,000 loss? Okay, well, $110,000 is above the $100,000 limit. How much above? Well, $10,000 above. Multiply 10,000 times 50%, you get a $5,000 phase out. As a result, the $25,000 limit is reduced by $5,000, making the new limit $20,000. Well, since their loss is only $16,000, they can still deduct all of it. In our next iteration, Mr. and Mrs. F's AGI is $140,000. Okay, so now they're $40,000 over the threshold. 40,000 times 50% is a $20,000 phase out. $25,000 limit reduced by $20,000 means their new limit is only $5,000. Well, their loss is $16,000, but they can only deduct $5,000 of that loss. What happens to the other $11,000? The rest is carried forward. It has to be carried forward to be used against other forms of passive income in the future. Okay, what if their AGI is $150,000 with the same loss of $16,000? Well, now they're $50,000 in excess of the threshold of $100,000. $50,000 times 50% is $25,000. Well, when I reduce the annual limit by $25,000, I get zero. As a result, they will be unable to deduct any of their passive loss without having some other forms of passive income. All right, did you enjoy your first phase out? I hope you did. So the second exception is related to the real estate professional. Okay, so let's go back and talk about Todd and Nelson for a second. So recall, Todd and Nelson were the ones that started the new food business. And they weren't subject to passive loss limitations because they were active participants. Recall that they materially participated in that business. Now, that wasn't a rental business, so they didn't have to worry about the general rule that says all rentals are treated as passive. Well, what about someone whose business truly is rental real estate, right? It's one thing if you're Mr. and Mrs. F and you own one rental residence that you rent out to some college students. It's an entirely different situation if you're Mr. and Mrs. F Incorporated and you own 5 apartment buildings and you rent out 150 units, right? So there are special rules in the tax code that say, you know what, real estate professionals, you get to treat your rental losses as non-passive. Okay, now does that mean that every real estate broker, every real estate agent you know gets to deduct their real estate losses? And the answer is no. You do not qualify for that just on the basis of being a broker, although you will find a number of brokers that treat it that way. Okay. Wow, that is a tough one, you guys. And I'm not going to lie to you. There's a homework problem that I've assigned for you that's just going to really task you. But I want you guys to do your very best. And if you have questions when you do it, and you'll know which one it is when you see it, on basis at risk and passive losses, post your questions in the discussion board. And collectively, we'll be able to work through it. Okay, thanks for watching, you guys.